Hello, welcome to the investing channel again. Thank you for watching this episode. What I want to do is take a minute and go through a financial statement. We're going to talk a lot about securities analysis, different companies, but let's go through the source material and see what are we going to rely on for material when we look at a company, and what information is trustworthy and accurate that we can depend on. And what you want to look for is a 10K. The 10K is the annual securities filing that a company does with the SEC. It can be found on the company's website. Typically, if you go to Google, you type in the company, and you follow that on with Investor Relations, it'll give you a link directly to the Investor Relations department of the company you're looking for. And within there, you will find annual filings. It is a 10K, or if it's not there, you can go to, sometimes they do a different format, but if you want the actual document, you can go to SEC search. You Google that. You'll be at the SEC government web page, and you can type in the company name or their ticker, and up will come every filing they make, all of them. It's a sea of information. I would suggest screening for 10-K. That will give you the annual report. It looks like this. Okay. This one is for Uber Technologies. That'll be fun. Uber fun. Sorry, bad joke. This is about 150 pages, which is fairly typical. They range about maybe 80 pages to, some of them can be 250 pages if they have a lot to disclose. This one's about 150. It's fantastic for just every detail, and they have to disclose a lot of information that they don't put in press releases, they don't put in investor presentations. This is where the rubber meets the road, and some companies do a really good job of giving you everything. Others, you have to kind of hunt for it, and we're going to walk through this together, and I'm going to give you an opinion, my personal opinion on Uber from a prudent, rational investor perspective. This is not at all a recommendation to buy or sell securities. This is simply my opinion, looking through the financial statement and wondering and asking questions. Again, as a prudent investor, what we are looking for is revenue growth, positive cash flow that is growing, a solid balance sheet, and positive net income that is also growing. So let's dive in here. I'll show you the cover one more time. Uber Technologies. 10K. This is for the ending year 2019, December 31st. It's the first full year financial that they have filed because they went public. When did they go public? In May 14 of 2019. They haven't been around that long on the public markets, but in here it gives the historical information that you would have otherwise received had they been public for the last 3-4 years. So let's dive in. Before we get in, this is going to be a little long. I apologize. I'm going to go into some detail, but I encourage you to go download the report yourself, print it out, get a cup of coffee or a scotch, whatever your drink is, and follow along with me. Make some highlights, make notes, and then we'll use this format as we go through other companies. I intend to do a lot of them, and I intend to follow them with investor presentations, and really try to understand what it is they're telling us, and is it reality. All right, let's move on. So, 10K Uber Technologies. The first thing that I would point out to you is this table of contents here. Table of contents, right? All kinds of stuff. A lot of times this is actually linked in the PDF. They're becoming much smarter with how they allow material to be accessible, and you can click and zip right to the file, or you can even download this stuff in Excel at this point. You don't even have to have the PDF. You can get all the tables write in Excel. That makes very, very handy to run numbers. But without further ado, the first section you should, you should read all of this, first of all. But one section particularly is the risk section, the risk factors section. It always comes up front. It's one of the first sections. This happens to be 35 pages of pure risk. This is just, lawyers, teams and teams of lawyers thinking about every conceivable avenue that could go wrong and writing it down. Some of them are like, environmental disasters, terrorism, cyber attacks. Some of them are more black swan events. Some of them are very real, very current, ongoing risks, and you need to know that they are real and that they are present. For example, one of the very first risks on page 11 of this 10K is the risk. We have incurred significant losses since inception. Including the United States and other major markets, we expect our operating expenses to increase significantly in the foreseeable future, and we may not achieve profitability. Youch. That's the header. Let's dive in for just another sentence or two. We have incurred significant losses since inception. We incurred operating losses of $4.1 billion, $3.1 billion, and $8.6 billion in the year ending December 31st, 2017, 18, and 19. And as of December 31st, 2019, we had an accumulated deficit of $16.4 billion. That's a lot of jack. That is a lot of money. Why are they losing money? Uber is everywhere. I've used them. They've got now the Uber, bicycles, the e-scooters. They've got the cars. They're talking about Uber Freight. They're talking about Uber Airplane. They have Uber Eats. It seems like they're ubiquitous. And if they're ubiquitous, why aren't they making money? We're going to find out. That's really interesting. They just IPO'd, right? So when they IPO'd on May 14th, 2019, they raised $8 billion in the IPO. That IPO is disclosed here in the risk factors, and that's again $8 billion is a lot of money that they use to fund these operating losses. So let's look at the income statement. Okay, try to understand how much revenue they have, is it growing, and are they profitable, and how, if not, how bad are they losing money? So we're going to go to the first income statement that appears on page 47, and I commend Uber for this. They are disclosing more than the standard 2 or 3 years. They disclose a full 5 years of P&L information, profit and loss, or income statement information. It's at a summary level, but you can see it here, right? I don't know if you can see that. It's pretty dark. But I'm on page 47, and in 2015, revenues just shy of $2 billion. Fast forward 5 years, 2019, full year revenue $14 billion. So they went from $2 billion up to $14 billion. Amazing, right? Right, fantastic. What happened to the operating income? So 2015, remember, doing $2 billion of revenue, lost $1.3 billion. All right, and then as revenue has grown, that loss has also grown. 2019 year ending $8.6 billion in loss on $14.1 billion of revenue. What's going on here? How is it they can generate $14 billion and not make any money? What's worse, you would normally see economies of scale, right? That's the argument. Oh, I'm small, I'm a startup, I need cash to operate, but when I get big, I'm gonna make a ton of money. Well, what's going on here and here is they're getting bigger and they're losing even more money. It's actually remarkable that their growth rate of revenue over those 5 years is 72%. The growth rate of expenses is 65%. So they're essentially maintaining their losing margin as they scale, which is a recipe for further losses. I'm not too sure how they intend to become profitable, but following their current MO, they don't appear to be becoming profitable. So I think that is one big flag for me and for this channel. Revenue growth, check. Fantastic revenue growth. That's, what is that? Almost 10x, probably 8 times total revenue over 5 years. It's fantastic growth. But the costs of that growth are growing just as rapidly, and they're not able to scale. Not as of yet. So that's a problem. I like the revenue growth. The losses are a problem. So if they're losing money, let's figure out how much, what does the balance sheet look like, and then how do they finance the losses. So the income statement shows what is the profit of the company, and then the balance sheet will show how they finance their operations. If they're losing money, how do they finance it? If they're making money, what are they doing with the cash that they're making, with the profit they're making? So balance sheet. Balance sheet is on page 78. Balance sheet looks like this. Typically shown 2 years running. So they've got 18 and 19 right there. And again, this is the 2019 10K. So what I'm going to do is zip right to the top upper right corner, cash. 10.9 billion with a little extra in short-term investments of 440 million. That's a total of 11.3, rough math, $11.3 billion in cash. Kudos to them, they have cash. Scanning down the balance sheet now, so that's cash. There's something that stands out. They don't have that many assets. In fact, they're very light on assets. The assets that they do have are investments in other technology companies. So here you'll see if I can do this with this camera. Investments and equity method investments. $10 billion. Well, assets are 30 billion. 10 billion is their investments. What is that? Is it liquid? Can I sell it? If they were to go under, is it a piece of equipment I can monetize? No. This is an investment in a private company that is illiquid. This is their Uber China that was sold to Didi, I believe. D-I-D-I. Chinese company that does kind of Uber technologies in China. So it's a private security. It's an investment that they don't control. They have no influence over. They are completely passive. If you read the disclosure in here, it says that they have no control. So they're along for the ride. And if the investor that's running that company messes up and falters, then the asset's going to decline really quickly. And there's no market for this security. You can't tell how much it's worth. Management makes an assessment, and their auditors look at it and say, this sounds about right. But it's not like it's a free liquid market with thousands of people smell checking the numbers and coming to an agreement freely. Not like a stock in our market, the New York Stock Exchange, with tens of thousands of people trading all the time. You get to a valuation pretty quickly. This is illiquid. So the point is, I'm not too sure what the value is there. I'm not going to question I'll give them credit for the 10 billion that's on the table. But if push came to shove, and Uber was declining and trying to realize that investment and had to sell it to turn it to cash quickly, they probably wouldn't be able. I just lost my screen. There we go. They might have trouble liquidating that investment. So I think that's an important distinction here, that this is not some piece of equipment that they could sell on the secondary market and get cash. This is a passive investment. And here's a cool thing. Uber Technologies is public, right? They have a benchmark value. When this company, Diddy, goes to value itself, it will go to an investment bank. That investment bank will pull market comparable companies. Uber is going to be one of those. So Uber, its valuation is used to determine the valuation of Diddy because they're in the same market. That valuation then is booked by Uber on its own balance sheet. So there's a little bit of circular reference going on, which is a problem if like we experienced in the financial markets today, the market tanks, if that value stays down for Uber in the long term, Uber could be writing this investment down. So I think that's at least a flag on the assets, that there's not much here that you can go after. Then on the debt schedule, what do they have for debt? Long-term debt, net of current portion. Now, this is frequent. They'll net long-term debt with current portion and put the current portion in the current liability section. Here, they don't break it out. So I'd like to see Uber do that in the future. I think they tuck it here with the accrued and other current liability section. But they should break that into its own separate line. But we're going to just call debt long-term debt, meaning it's due beyond 12 months, $5.7 billion of debt. Now, if you go further in the back, page 112 is their debt schedule, and you will learn that none of this debt is due within the next couple years. Let me see here. None is due until 2023. So 2020, 21, 20, 3 years, no principal payments. And then there's a balloon payment, $1.6 billion is due. Now, what we should do is, yes, you technically don't have to pay the cash out. A bank has given you credit so that you can continue to grow and you don't have to have the cash to make the payment. But that is going to come due. And if they can't fix their margins to be profitable, they're going to have to issue debt or a stock to pay that bond. A prudent person would say, if they owe $5.7 billion, I'm going to amortize that over 5 years, which is a standard kind of corporate loan, every year making about $1 billion payment. So in terms of cash, what we should think is that these guys have to make about $1 billion in payment a year, if not to the bank, at least to reserve it for the eventual term debt that's going to come due. Again, only $1.6 billion is due in 2023, but they have to be paying down this debt over time. So I'm just assuming it's going to amortize and be paid off in 5 years. So that's an issue. They've got a lot of debt. The assets that they have aren't all that liquid. They're not even in their control. As an example, so a comparable would be Hertz Rent-A-Car, right? If Hertz Rent-A-Car, they're listing on their balance sheet the cars that they own. Yes, the cars are financed, but the cars are theirs. They're on the balance sheet. They're under their control. If something happened, they could liquidate them very quickly. The used car market is extremely liquid, and they could turn those cars into cash and pay a vendor or an obligation with that cash. This here being $10 billion, a third of their balance sheet, is illiquid and doesn't have a real good value. So you just need to keep that in mind if they were to struggle. That's a concern. So then that's the balance sheet. I think we've covered what I wanted to discuss. Oh, the last thing I forgot, the debt interest payments. So one way to smell check the creditworthiness of a stock investment is to look at the interest required by the lenders that are giving debt to the business. So remember, in the capital stack of a business, you've got your immediate creditors, payroll, vendors that you may have taken money from to do various businesses, your Amex payment or whatnot. And then below those, you've got your capital stack, and you've got your debt, mezzanine, preferred equity, and then common stock. So as us, as common stockholders, we're all the way at the bottom of the collateral stack. So if there was ever a problem with the company, they ever had to go go into bankruptcy and get a workout, you're the last to receive any money if there's anything else. And you're the first to take a hit if the judge is like, sorry, we have to get rid of all the equity, get new capital, and that means you lose everything. So it's important to just smell check what you're buying into. If you're buying for growth, Uber's definitely a growth story. What are you buying, and what are other lenders lending at? What's the risk factor? So without further ado, their range of debt is 6.1%, and this is probably floating rate, by the way. So it's probably above that. 6.1% to 23% is the high end. So that's a pretty big range. They're borrowing money at 23% interest from lenders. Now, us as equity investors, we should be making more than 23% because we are further down on the capital stack. We have more risk. So that's a problem. That's expensive money, 23%. As a comparable, quickly. Another project of mine that I'm going to work on is kind of a gold standard for balance sheets. Ooh, the great Apple. All right, so look, Apple does one up. They even list on the cover, let me get my hand out of the way, of the cover of their 10K, the interest rate that they're currently being charged by their lenders. And these notes, these interest notes, range from less than 1%, so 0.875% interest, up to 3.6 is their, at least on this top page, the cost of their debt as compared to an Uber, whose lowest is 6, highest 23. So that gives you a kind of a smell check of what the banks, what other financial professionals think of the credit quality of Uber. But let's move on. Let's get to my personal favorite statement, which is the cash flow statement. It must be weird to hear someone say they have a favorite financial statement, but I do. It's pathetic, but I do. Cash flow. Cash flow is how you value a business. Cash flow is what you get when the business grows or shrinks or falls. This is the lifeblood of a business. It's cash flow. And what we're after is free cash flow. Free cash flow specifically to the equity holder. So what we can dividend out as money. If you had to, you could burn it and the business would not be affected. This is money you could tuck in a bank and swim through like Scrooge McDuck. This is the holy grail of why people start businesses. It's for the free cash flow. So let's go look at this. Cash flow statements look like this. They're typically in the back of the financial statement. And you typically get 2. This one actually gives you 3 years, which is nice, of comparables. I am on page 84 for reference. So let's zip down to operating cash flow, or cash from operating activities. You can see it right there. Cash from operating activities, also called CFO. How do I get that there? Can you see that? The cash. So this is when you run your business. When you run your business, what are you generating? 2019, the last full fiscal year, they lost in pure cash money $4.3 billion. It's a lot of jack. Year before that, $1.5 billion loss. Year before that, $1.4 billion. So that loss, the cash burn, is actually increasing as they're growing, which is in relation the same as we were saying before. As revenue was going up, operating expenses were going up, and comparable here, same pattern is happening. Cash burn from operations also increasing. If I do that on kind of an average basis, just smooth out the 3 years, say on average, they burned $2.4 billion each year on average. Then, in addition to the cash flow from operations, what you need to do is you need to reinvest in the business. Before you can get free cash flow, you have to say, what are the business generating cash this year? And then what do I have to put back in the business to make sure the business doesn't degrade over time? This is called CapEx, or your capital expenditure. They're typically large investments in property, plant, equipment, could be technology, development projects, anything that you're engaged in that would be a long-term investment, something that you did now or you're doing now, and maybe it takes a couple years to build some big factory, or maybe it's a piece of real estate you're buying because you're going to make it into a warehouse, or they're a giant server project and you're buying it. It could also be computers and desks and chairs for employees, painting the building. All of that kind of upkeep to maintain the business, that's CapEx. So you have your cash flow from operations, which you generate, but then you have to subtract from that the CapEx to see what you actually get. So their CapEx averages $655 million. You can see that it's called purchase of property and equipment, right 2 lines underneath the cash flow from 3 lines underneath the cash flow from operating activity. So what we do is then you add that, or in this case you subtract that from the cash flow from operations. So if cash flow from operations is averaging $2.4 billion, you add on top of that another cash outlay of $655 million, you get to $3.1 billion a year on average that this company is burning, both in operations and in investment in its business. If we then take this one step further, and if you remember I said about the debt that they have, the $5.7 billion of debt. Make sure I got that right. It was on the balance sheet. Yeah, long-term debt, $5.7 billion. So if you take that and you spread it out over 5 or 6 years, that's call it $1 billion a year. Just rough mental math. $5.7 billion over 6 years, $1 billion a year. So you take the billion that you have to reserve or pay down your debt. They're choosing not to do that here, but if the prudent thing would be to do it. That billion on top of the $3 billion is $4 billion a year of cash burn. So if we're averaging the business over a period of time, and I like averaging it because it helps smooth out some accounting changes that you can do. So on average, these guys are burning $4 billion a year in cash. The question is then, how much cash do they have in the balance sheet, and how long do they have before they run out of money? Cash on the bank, we already covered this, $11 billion. You take the $11.3 billion divided by 4 of the cash that they're going to burn, you come up with 2.7 years. That takes us almost to the end of 2023 before they're out of money. So between now, we're in this, from this financial statement, it's the end of 19. So 2020, 2021, and 2022 and some of 2023, they will burn out of cash, and they're going to have to either raise more debt. Their debt is already in the 6 to 23% interest range, or they're going to have to issue stock, which means dilution to you and the down share price. And that's important. Remember that. If they fail in the business plan and they have to go to the bottom of the barrel of the capital stack, which is equity, which is what we buy, they're going to print it, send it out there, and the share price is going to fall. So that is a major risk for investors, and we need to be cognizant of that. So they're currently burning cash, which is, when we think of our hallmark, what are we looking for, right? Revenue growth, earnings growth, profitability growth, a solid balance sheet, and positive cash flow. These guys don't fit that mark. What I wanted to do now is talk a little bit about a metric that Uber uses, and a lot of other technology companies use this. It's called adjusted EBITDA. Uber does it, all kinds of companies in Silicon Valley do it, and it's really a shame that the institutional investors allow companies like Uber and any of them to use an adjusted EBITDA. It's not the right number. They shouldn't be using it. and I'll show you something in an investor presentation from Uber that I think is particularly troubling in a second. First, I want to pull up the page. Uber does give a nice description of what is in the adjusted EBITDA. That's on page 66 of their 10K. So kudos to them if they're going to use a made-up metric, which is a metric called adjusted EBITDA. Sorry, my screen died again. Adjusted EBITDA. Then at least you can do is give us a solid definition and build up to what's in this metric, which they do. Kudos to Uber. So first of all, let's talk about EBITDA to make sure everyone's on the same page. EBITDA is an industry-used calculation. It's not a GAAP number. Okay, GAAP is generally accepted accounting principles. EBITDA is not a GAAP number. It is a number that is a proxy for cash flow, and it's easy to calculate because it's not very in the weeds. It's a number that's basically your earnings is the E before interest, tax, depreciation, and amortization. So it's earnings before interest, tax, depreciation, and amortization. EBITDA, EBITDA. What that means is essentially take your operating profit, or we'll start at net income. If you take your net income, right, you add back taxes, you add back interest, you add back depreciation, amortization, you get essentially a cash flow number. It's not real cash flow, it's a proxy, but it's a proxy for cash flow that's supposed to represent the business if it were debt-free. Why debt-free? We can cover that in a different episode, but essentially if a company's buying a business, they can choose, the new owner can choose how they want to finance the company. If they want to just have zero debt and come out with cash all at once, then they're buying, and that EBITDA is all for them. So it tends to level set businesses between one business and another that might have different capital structures. If you go to the EBITDA, you just kind of exclude the interest, and it helps level set for the debt on the business. The depreciation and amortization that is related to CapEx, they're adding that back because some businesses that have really capital intensive businesses have to put in a lot of money into their property, plant, and equipment. That's not on the P&L. And the depreciation itself is a non-cash charge. So they're adding that back to, again, level set to a very high level cash flow proxy. It's more of industry standard now than it is a real measurement of cash flow. What we did earlier is cash flow. Cash flow from operations, less CapEx, less debt service. That is cash money that you could spend, dividend out, whatnot. EBITDA is a proxy. You can't dividend out EBITDA. That was a long definition of what EBITDA is. And then these guys take it one step further. They say, okay, here's my net income, my taxes, my depreciation, my interest. And then, oh, by the way, here's a whole lot of other stuff that I incurred that were expenses to me, but don't look at this. I'm gonna add those back because I don't want you to actually pay attention or classify those as expenses, which is a problem. Some of these, the biggest one that everyone in Silicon Valley loves to add back is the stock-based compensation, right? So this is an employee benefit. Great. I'm a huge fan of giving employees equity. I think it helps retention. It aligns interests for shareholder value so that everyone in the company feels like they're pulling in the right direction and they're going the way that they need to go. Fantastic. But it is a cost. Just like their salary is expensed, their bonuses are expensed, their benefits are expensed, but this particular benefit, stock-based comp, they don't expense. That doesn't make any sense. And you can see it here. So this is really difficult to see, and I apologize for that. But this is essentially the adjusted EBITDA calculation. And you can see some of the chunky numbers in there, stock-based compensation being one of them. So as a result of the IPO that they did, they're adding back, wow, $4.6 billion of stock-based compensation, which you got to expense that. That's equity that they're issuing, diluting the common stock shareholder, which would be you and I in this case. So we're paying for this. And then they're saying when you judge their performance, don't look at this. That makes no sense. Some other things stick out on here that I think are worth noting. Let's see. They've got legal, tax, and regulatory expense and settlements that they're adding back. Which, okay, if you're in a litigation or something which is one time in nature and not germane to your business, I have seen this added back. I've added it back myself. It makes sense if it's a isolated incident. The problem here is it happens every year. Furthermore, it happens every year and it happens roughly the same amount. So 2017, $440 million. In 2018, it's $340 million. In 2019, $350 million. That's over $1 billion. If my mental math works, you can smell check me on that. In 3 years, in legal and settlements, that should not be added back. If it happens every year and it's fairly consistent, it is a cost. That is part of your business model, is to defend yourself against lawsuits. I'm assuming from maybe drivers related to, now this is complete conjecture on my part, but it could be either A, defending the consulting versus employee litigation that the states have been going after, or B, drivers of Uber getting into accidents and then those people who are injured, there's lawyers suing Uber for settlements. That could be that. In which case, that's all part of the normal operations. They should not add that back. A couple other things in here. Stock-based comp we covered. Equity method adjustment, pension provisions for income tax. I don't know about that one. Oh, here we go. Impairment and loss of asset impairment / loss of sale of assets. $340 million. And another one of $235 million. So these are expenses that they're adding back. So let's just think about this for a second. They made an investment from equity that they raised, either in the VC world or when you did the IPO for $8 billion. They took this cash, they put it into investments, much like the Diddy investment in China, and they have others on the balance sheet. They then realized that the investment did not go where they wanted to go, and they wrote it down. That loss they hit the P&L with, and now they're saying, don't judge me for how I invest money. Let's sweep that under the rug. Yeah, but that happened 2 years in a row. $340 million in one and $237 million in another. That's a lot of money. And no, you were making that investment decision choice. You should be judged for that. So I take umbrage with that. They should not include those in the add back. Basically, the gist here is you go from a net income loss. We'll take 2019 as an example. 2019, a loss, if you can see that number there, that is $8.5 billion of a loss. And after massaging with the add backs, they take an $8.5 billion loss and they turn it into a loss of $2.7 billion. It's a massive restate. And they're saying, excuse me, they're saying that they don't want to be judged by their net income. They don't want to be judged by EBITDA. They want to be judged by an adjusted EBITDA, which is a number that they created. So why am I bringing this up? Normally, I'm not talking about EBITDA. I will in the context of valuing a business as a way to smell check a cash flow valuation. But right now, the reason I bring it up is not to value the business, but because Uber themselves use the adjusted EBITDA when they refer to the term profitability. That's not right. Profitability is net income. Profitability is not a non-GAAP number that you then adjust to become profitability. And look, this was a while ago. Remember when WeWork was going public, and the investor community started looking at the financials and started realizing that it did not make any money, and that they started questioning their business model, and the whole thing melted down. They melted down because the cash flow, the income generation just wasn't there. And investors said, you know what, guys, this time of being unprofitable is coming to an end. You cannot be unprofitable forever. You must become profitable. And all the other tech companies scrambled to show that, no, we're not going to be, we will be profitable sooner than we originally told you. And Uber was one of them. So here's a slide from their 2020 investor presentation, released February 6th, 2020. Let me show you this. Right? So what are we looking at? This is profitability right there. And it says path to profitability in 2021, and that's very impressive. Like, wow, profitability 2021, that's 2 years from these financial statements? Okay, I can do that. How profitable are they? Right there. In 2021, that's a percent of revenue, and that is right above the break-even line. So that's there's no numbers here. I can't tell you what percent. I'm guessing that's 1%. Just looking at the number. So 1% profitability in 2021. That's 2 years from these numbers. If you recall, I said they've got 2023. 2.7 years is when they run out of cash. So they're saying, hey, we're going to be profitable in 2 years. Meanwhile, they only have 2.7 years of cash on hand. They're going to have to raise more money. Second, profitability. What is this? Profitability is adjusted EBITDA. They say it right here. Adjusted EBITDA. That's not profitability. So they're telling you they're going to be profitable, but really, we just showed you the adjusted EBITDA is not profit. That's not net income. Their net income was $8.5 billion of a loss. They turned that into $7.5 billion, and then they're saying that this $7.5 billion here, after all this add back, will eventually be almost zero in 2 years. Well, that still means that net income is going to be a loss. That still means that you're not going to be able to make debt service. That looming payment for the bank, that the balloon payment of $1.5 billion, it's going to come due, and they're not going to. Well, I don't know if they're not going to, but it's going to come due. So they have major problems here. This profitability that they're telling people isn't real profitability, and that's the shame. They say long term here, right? Oh, well, long term I expect to be at 25%, but they give no indication of when they think that long term is. And if history has been a guide, in the last 5 years they have grown revenue fantastically, but costs grow the same. So if there are no current economies of scale going from, 2 billion roughly to 14 billion of revenue, how big do they need to be to eventually be profitable? And that's a serious problem. I'm not seeing how they're going to get there. And they have lots of fancy metrics in these presentations. Oh, take rate, adjusted EBITDA per rider, all kinds of machinations that let creative analysts find a data point that they can point to and say, look, this is going up. But what matters is cash flow. And cash flow is still negative, and cash flow appears to be negative into the future. And they could have done a really good job here. Instead of calling profitability adjusted EBITDA, they could have made this cash flow. The next slide after this, they go into cash on hand. Good job. But it does not say when you're going to generate free cash flow. When will you be cash flow positive? So This is an interesting story. We're going to have to watch Uber. Again, not a knock on the service. I think the service is amazing. I think the company is filled with great and dedicated employees. I've known nothing but good things to say about those people. But the business model, fundamentally, I think is underpricing its service. And the people who have to pay for that underpriced service are the equity holders. That would be you and I if we bought it. And so we are funding the losses that they're carrying forward while you go and write. And it's bizarre. I mean, that's like if you were to go to a movie theater, right? You walk up, you give the cashier $20 for a movie ticket, and he hands you $22 back. You would be like, wait, why did you just give me change that's more than the price of the ticket? That's essentially what's going on here. They're paying out increasing amounts of money to grow revenue, and they don't appear to be on track to generate free cash flow for quite some time. And there's a lot that can happen between now and then that would cause them to be in financial difficulty. So for this reason, I'm passing on Uber as far as a investment opportunity right now. They do appear to have one of the metrics we look for, which I said is revenue growth, but they're lacking a solid balance sheet. They're lacking positive cash flow, and they're lacking profitability growth. So that's the review of Uber. I'm gonna go through more 10Ks in the future. Let me know what you think. Comment. I'm happy to answer questions or talk about Uber and see where they go. I wish them the best of luck. But for now, I'm going to sit back and watch what happens.